All right, let's talk about Bitcoin, because the tension in the market right now, well, you can feel it. After a pretty big correction back in February, everyone's asking the same thing. What is coming next? So today, we're diving deep and asking, could this March be a truly pivotal moment for Bitcoin?
And that really brings us to the one huge question on every single investor's mind. Is all this volatility just the prelude to a massive rebound? Or is this the beginning of a much deeper, much scarier fall? In this explainer, we're going to break down both of those possibilities.
You know, everything we're going to talk about today really hinges on this one powerful idea. If there was no extreme overheating, is there a reason for extreme capitulation? This isn't just a random thought. It's the exact question that professional investors are wrestling with right now. And frankly, it's the key to figuring out what might happen next. Okay, so first things first, let's just look at the price action itself. This brings us to our first section, the $60,000 question. Is this supercritical price level a solid floor that's going to launch the next rally, or is it a trapdoor leading to way lower prices?
So if you pull up the charts, you'll see something pretty classic taking shape. Bitcoin has dipped down to retest that $60,000 support level, a low it touched just a few weeks ago. And when you see that, it creates this potential W shape, a pattern that, trust me, always gets the attention of technical analysts.
And for anyone who's not a chart wizard, no worries. This is just called a double bottom, or a W pattern. Think of it like a textbook move. It often signals that a trend is about to flip from going down to going up. I mean, basically, the market tries to push lower once and it fails. It tries again and it fails a second time. And that can be a huge sign that the sellers are just exhausted and the buyers are finally ready to step in and take over.
Okay, so the charts are painting a pretty hopeful picture, right? Well, hold on, because when you look under the hood at the actual blockchain data, the story gets a whole lot murkier. This brings us to the on-chain dilemma and what that data might be hiding from us.
So let's talk about a key metric called the MVRV Z-score. Now, you don't need to know all the math behind it. Just know that it helps us see if Bitcoin is overvalued or if it's kind of on sale. In past bear markets, the true bottom signal, it only ever flashed when this score fell deep into negative territory, what all the analysts call the green zone of max opportunity. But right now, it's still positive. And that is the #1 argument the bears have, that the worst is still to come.
And check this out. This number shows the point perfectly. In the past, when the market truly just gave up, I mean full capitulation, the MVRV Z-score would drop to around -0.2. That was the all-clear signal for savvy investors that the absolute rock bottom was in.
But today, look at where we are. The score is sitting at a positive 0.26. That's a massive difference. And that's the crucial point here. Based on all the history we have, we're just not in that deep value zone yet. So you see the problem, right? The charts are hinting at a bottom, but this key on-chain metric is screaming not yet.
So, what gives? How can the charts say one thing and the data say the complete opposite? Well, that leads us to maybe the most important argument in this whole explainer. What if we're playing by a new set of rules? Let's explore why this cycle is just fundamentally different from every single one that came before it.
So let's just walk through this table, because the story it tells is crystal clear. Think about past cycles. They were all driven by extreme retail-led mania, right? That sent all those on-chain metrics through the roof. This cycle, though, it was different. The 2025 peak was driven by steadier, institutional money coming in through spot ETFs, which led to a more moderate, less overheated rise. And that changes the entire outlook for the drop. A manic bubble pops and leads to a 70% plus crash. A more structured rise, that suggests a more standard 40 to 50% correction is a lot more likely.
And this quote just captures the idea perfectly. Less foam in the bubble means there's less bubble to pop. Since the peak in 2025 wasn't driven by that same level of retail craziness, the argument is that a catastrophic crash just isn't in the cards. There simply isn't enough mania to wash out of the system. Okay, cool. So the game has changed. But what does that actually mean for us right now, heading into March? Let's move on and look at the forecast for this really critical month, weighing the case for both the bulls and the bears.
For all you bulls out there, there's actually a lot to be optimistic about. First, if we successfully hold that $60,000 level, that would complete the W pattern, and the technical targets start pointing up towards the $75,000 to $80,000 range. Second, March is often a turning point after seasonally weak months like January and February.
And third, you better believe that $60,000 level is seen as a super attractive entry point for the big institutional players who live by that buy the dip mantra.
But okay, let's not get ahead of ourselves. It is not all sunshine and rainbows. There are some serious headwinds. For one, some key long-term moving averages are now sitting above the price, acting as a ceiling that could stop any rally in its tracks. We also have huge macro events in March, like inflation data and a Fed meeting, which always stir up uncertainty. And finally, like we just saw, those on-chain indicators still haven't given us that definitive all-clear bottom signal.
So you've got the bull case, you've got the bear case. What are you supposed to do with all that? Well, let's try to put it all together into a simple, practical guide, a roadmap for what you need to be watching for in March.
Okay, here's how the month could play out. Think of it in 3 parts. In early March, look for a technical rebound attempt up towards that 70 to 75K range. The key thing to watch here is whether we see those institutional ETF inflows start to pick up again. Then, mid-March is almost guaranteed to bring volatility around those big economic reports. And by late March, we should get a real directional decision. The big test is going to be, can the price break and, more importantly, hold above that $80,000 resistance zone?
You know, someone put it really well. They said, March isn't going to be a simple up or down month. Instead, it's a period where 2 major forces are going to intersect: the market's attempt to confirm a true bottom around 60,000, and at the same time, its push for a relief rally back toward those higher levels. It's going to be a tug of war.
All right, we have covered a lot here. Chart patterns, on-chain data, the whole macro picture. But after all of that, what's the one thing, the single most important idea that you should walk away with?
It really all comes back to that core idea we started with. If there's no driver, there's no deep fall. The most compelling argument against a catastrophic 2018-style crash is the nature of the last peak. The fact that we didn't have that extreme manic overheating is the strongest reason to believe we won't see an extreme collapse now. And that idea is probably going to define where the market goes, not just in March, but for the months ahead. Thanks for watching.